Most people invest in properties because they want to build a financial safety net. They want to build more passive income and have more options in life later on. Property certainly isn't the only way to get there, but definitely a proven system that many people have utilized to build wealth in the past. But why? What's going on, everybody? It's Blandon here again from Mortgage HQ, and in this video we're going to discuss 3 reasons why you may consider investing in properties. And remember, if you learn something, smash that like button for the YouTube algorithm. So reason number 1, it is the simplest asset to understand out of the 5 common asset class. So the first one being cash, which is money in the bank, yielding you around that 0.2 to 1%, depending on what term you take. Number 2 is bonds. So that's a few percent higher than cash. And then properties, traditionally in New Zealand, it's been sort of averaging around that 6 to 7% mark. Fourthly, you've got shares, which is around that 8 to 10. And then cryptocurrency, a few 100% probably in the last couple of years. Now, when you invest, you're always looking for the risk that you're taking and then the return. So if you plot all 5 of these asset class on a graph over time, you're gonna find that cash and bonds are probably a lot more steadier when compared to shares and cryptocurrency. But properties is going to be smack bang in the middle, more return than your cash and bonds and less volatile than cryptocurrency and shares. And if you ask mum and dad, hey, which asset class do you understand the most? Chances are they're going to say cash in the bank or properties. It's brick and mortar, it's tangible, easy to understand, and it's one of the asset class that the bank is willing to lend you money on and only charge you an interest rate of around 3%, which leads us to the second reason, leverage. So the big upside with leverage is that you're building wealth using other people's money. If you have an existing property and over time the value's gone up, you might be able to just borrow 100% finance to buy the next investment property without putting any of your cash in. Now, if you're able to use that 100% finance to buy a property that looks after itself, meaning the rental income covers all of the interest expense and outgoings, you're effectively accumulating or earning the capital gains on that property for free. So if you buy an investment property for $500,000, for example, and let's just pretend you get 5% return, all of the rental income is going to cover all expenses. So that means you're just waiting for the capital gains. And you didn't put any money in, this property is going up $25,000 a year. So what kind of return is this in finance? Since you didn't put any money in, it is defined as infinity, because you're getting something for nothing. But do keep in mind there is an opportunity cost, which we would probably discuss in another video. You want to compare what you could potentially 100% finance on so that you can maximize the return. Now, if you want to learn how you can buy a second property without putting any money down and just using the equity on your property, I have a video in the description below. Now, let's say in a second scenario, you buy a property and you decide to put some money in and you want to put in a deposit because you want less mortgage. Depending on which bank you go to today, there are banks that will offer you 80% finance, but most of the main banks with the lower interest rate will allow you to borrow up to 60%, meaning you have to have 40% deposit. So let's say the same $500,000 property and you're going to use a non-bank, you want to put down 25% deposit. That's $125,000 of your own money. Now, again, we assume all expenses are covered by rent and you get 5% return on the $500,000 purchase price, meaning you get $25,000 of capital gains per year. And the money that you put in is $125,000 and the return you're getting is $25,000. In other words, you're getting 20% return. This is because of leverage. You're borrowing some money, but you're maximizing your return. And so in this situation, you're getting double the average of what you would get in shares. And the money is sitting in a relatively less volatile asset. Now, of course, there are disadvantages with leverage. The biggest one I can see is that it's got interest rate risk. Now, although you might buy a property that might be cash flow positive, meaning the rental income covers all its expenses, interest rate could go up. And so to mitigate for this risk is you want to buy higher yield property, meaning you get more rental income. You could potentially use revolving credit to cover for any shortfalls. If you don't know what a revolving credit is, there is a link in the description. And also you can mitigate the risk by having good mortgage structure in place. And this is what our mortgage advisor is going to be able to help you with. So the third reason you might want to do properties is because of the instant equity. Typically, there are 3 reasons why you might earn instant equity. First being someone just wanting to let go of the property quickly and price is less of a concern for them. Sometimes this might be a deceased estate, sometimes it might just be an argument between the owners, or sometimes maybe they have already bought somewhere else and they need to sell it really quickly. Second reason is because they're poorly marketed. Yes, there is a difference between good marketing and bad marketing. If a listing have bad photos or something that's not as attractive, you're going to have less clicks and therefore less traffic and therefore less competition. They could also be targeting the wrong market for that specific property. For example, maybe trying to target first home buyers when the property is more suitable for developers. So online visibility is quite important. And also sometimes the agent might just not be following up properly and so they miss some sales and piss some people off. And thirdly, seeing the hidden value. Now, what does this mean? There are 4 ways you can see a hidden value on a property. Number 1 is buying undervalue. So you might be shopping in a particular suburb, you understand it really well, and you know what everything is selling for. So instantly you're able to identify that a property is undervalued. Secondly, you see a renovated value and it's selling for below that plus the capital that you have to put in. Thirdly, you could see a mini development potential for the site. Perhaps you could chop it up into a home and income, perhaps you could put a minor dwelling at the back, or you can extend the house for more income. And not everybody's going to be able to see that hidden value. And the 4th way you can see the hidden value is through the development margin. This is the biggest risk and it's also the biggest discrepancy for the highest return. So if you understand how development works and you can work out the numbers, sometimes you might overpay on the market price, but you'll be buying well under what it's worth depending on what you could build on it. So there you have it, folks. The 3 reasons. First one being one of the simplest assets to understand. Secondly, you could use leverage. You could borrow money from the bank to invest in this particular asset class. And lastly is an instrument that you can gain instant equity. And because if you can buy $1 million property for under 10%, you're making $100,000 on the way in. And if you could buy $1 million for 10% below market value, you're making $100,000 on the way in. Did I miss out any other reasons on why you would invest in properties? Leave a comment below. I'll see you guys in the next video.